First, I want to say thanks to everyone that's joining today. I want to say a special thanks to Greg Crabtree. I've known Greg now for good grief, a very long time. I have gotten to know Greg very well, and his material and his content in simple numbers, quite honestly, changed my business. It changes the way that I coach, and I can't think of a better person to talk about inflation and pricing strategy and how it impacts small businesses. And so I want to make sure that we spend most of the time here with an opportunity for everybody to contribute. I do want to say thanks. This was put together by John Lund, who has Entree Smart, a coaching business based out of Nebraska. My B2B sales coach, another, if you are looking for specific sales coaching, they're fantastic. And then, of course, my business, Simons.Coach. And I've had the joy of being able to work with Greg's team for many years. And so with that, I just kind of want to start, Greg. I don't know if you want to do a quick intro. I think most of the people I'm seeing on the line know you, but just in case somebody doesn't, why don't you kind of give them a little bit of your background?
Had my own CPA practice for many years, started it way back in 1986, and then ran across this interesting little organization called Entrepreneurs Organization back in 2001, which is called YEO back then. And you know the the intersection of EO and the world that it brings you in connection with has totally changed the trajectory of my thinking about the needs of entrepreneurs, because I always had this was bubbling up inside of me of wanting to do more, because as a CPA by trade, we suck at really supporting entrepreneurs, and there just had to be a better way. And so between forum, EO events, getting to meet people like Rob and John Lunn and those folks that I've known for years and years. Those are the people that are the catalyst that keeps me driving forward to kind of find what is it that really meets the need of an entrepreneur, that gives them that return on investment that's relative to the risk that they take. So in 2020, our practice had grown substantially thanks to Rob's coaching. Rob came in as our business coach for our practice in 2016, and just we finally had breakthrough growth that we had been stuck for quite some time, and allowed us to kind of get on the radar of a national firm, Carr, and Ingram. And so we merged right before the pandemic. But we've still continued. We're still the same. We do the same thing we were doing before, and so we're kind of an oddity in their world. We're really a national practice unit. We don't really focus on any geography. We've got clients all around the world that we do this for, and it's really given us an interesting insight as a pulse to the economy, what really is happening. That's a data driven view of things versus what you feel in a very narrow sense. And so since our clients in the US are coast to coast, north to south, and all different industries, we feel like we've got something to share that really is going to set the stage. I mean, to a certain degree, I may scare the bejeebies out of most of you, based on what I'm about to tell you. So just be prepared for that. But I think we're in a time that we're going to see the greatest separation between the real entrepreneurs and the people that were just enjoying a massive gift of the market for the last 10 years. Is I contend from the data I'm looking at that we probably had one of the fastest, most aggressive business expansion period in the U.S. history from 2010 to 2020. And really it ended right at the end of 2019, based on the data that we're looking at. So let me jump in. Rob, certainly feel free to interrupt, or you and I talk about this all the time. So you kind of know how the flow goes, and if somebody asks a pertinent question in between, feel free to interrupt.
Yeah, I'll monitor
Um,
the chat and the Q&A. And please,
yeah.
if anyone on the call has a question or comment, please just put it in the chat, and we'll get
Um,
Greg to hit on it.
so So I was tasked with, I'd gotten a request from the EO Western New York chapter in Buffalo to do a presentation on pricing strategy, last year, about this time last year. And And I said, sure, we talk about it a lot. I just never put together a deck to kind of cover our thoughts. And said, but that's no problem. So as I was working towards, getting ready to do the event, we had this data that we kept seeing from our 100 company model. And that I said, I really need to blend two things together. I need to, number one, first and foremost, give people an assessment, because pricing strategy is kind of one of those things that you regularly do, but it's a little more, contained in a stable economy. And what we really were seeing is a much more aggressive need of people to understand first the condition of the economy, to then correctly apply the pricing strategies that were necessary at the moment. And I will probably say is going to be necessary for the foreseeable future. Number one is the economy did far better than reported during COVID. And so businesses had significant profitability growth. There were a handful of businesses that struggled, that, had forced lockdowns and those things. But for the most part, I mean, we only had one client go out of business out of 500 that we served, because during COVID, and they were in the entertainment, industry, that they were in a lockdown situation and just couldn't survive. But everybody else made it, and many of them made it swimmingly well. Second thing, inflation is real and it's going to continue to challenge your pricing. So as I said, this isn't transitory. I think everybody's kind of come to that conclusion, but you're still thinking about, well, maybe it'll last for another 6 months to a year. No, I think at least 5. But understand that this is not unusual in the world. I mean, one of the nice things that I've had the opportunity to do, I've presented my material in 15 countries around the world. And business is business. And a lot of those countries face far worse situations than what we're facing on a daily basis. The only time I've ever been stumped temporarily in a presentation with a question from the audience was I was in Buenos Aires doing a talk, and I was talking about my 2-month core capital target idea. And they said, well, we have 20% a month inflation. And I said, keeping cash is a bad idea. And I said, you're right. And so we talked about it a little more, and we actually determined the reality is they do keep cash. They just find a way to keep it in a more stable currency. And just understand, currency takes a lot of forms. I'm a chicken farmer from Alabama. Guess what? Chickens are currency. Eggs are currency. Yeah, so I can take a chicken and hold one under each arm. So keep in mind that there's a lot of ways that the world of business trade operates in these unusual times. Third point, I can't stress this enough. The labor shortage is permanent, and I'll make the case for the conditions as to why that is. This is the biggest point that the politicians, the economists, the pundits, everybody's missing as to why inflation is going to continue, for the foreseeable future. We obviously know about supply chain issues. Some of my clients it affects more directly than others. And we follow some folks with some really good insight on that. But it's a tough challenge, and it could kind of break at any moment, to a negative degree. M&A market, though, continues to be pretty hot. There's still way more money chasing way too few businesses, so so from that standpoint, that part of it's, probably going to continue. And so then I'd thrown this in when I first did this slide deck, and I was kind of proven to be true. How can the stock market justify a 30 price to earnings ratio? Well, it can't, and it didn't. And so the stock market is probably bubbling around somewhere between a 18 price to earnings ratio right now. I mean, and here's the sad reality. And actually, I think it was Rob that had shared this data with me that kind of helped. I'd been talking about this, and he ran across a piece of data that validated it. If you really look back to the year 2020 and extrapolated the number of public companies forward, there should be twice as many public companies in the open market as there is today. And because of this layer of private equity that has kind of created a sub-layer beneath the public markets, it has created access to capital, liquidity, valuations that are just as good, if not sometimes even better than public companies will offer. And so all the reasons why people used to go public, a lot of those have gone away. And so at this point, you've got 401k money every week that's being withheld from people's checks is coming into the marketplace, going into mutual funds, and the mutual fund manager has to buy the least ugly stock. And they'll pause at times. Right now, they're sitting on the sidelines. If you looked at all the mutual fund guys, I mean, their cash balances are doing this. And so they released some of it a couple of weeks ago, and you've seen the market kind of come back a little bit. And then they get concerned about interest rates, and it goes down a little bit. But eventually, it's probably going to rise back into the 20s eventually, and maybe even hit 30. Kind of 30 is the stupid number. I mean, if it gets much beyond 30, I mean, I'm really concerned, but just understand this: when a stock is trading at a 30 price to earnings ratio, if they paid 100% of their dividends out as out of their profits out as dividends, they would be less than a 2% yield investment. That's not good for an equity investment, and it makes no sense. And so the markets, they get out of kilter and they find ways to balance themselves. But just keep that in mind if you are investing in the market. But here's the last piece, and I this is what I say in the Simple Numbers 2.0 book, is I lead off that book with, you know, finding the need of business and finding a way to meet that unmet need. That is the entrepreneur's dream. And when there's an unmet need that I can find a way to do it profitably and get my required return on invested capital, I'm going to be successful as a business, regardless of the marketplace. Now, you're going to see some changing, shifting needs as things that are, I always kind of break the market between the necessaries and the discretionaries. And I would ask everybody that hears this presentation, ask yourself the question, are you a necessary or are you a discretionary? And if you're a necessary, I mean, you got to go a long way before, there's either a lack of availability of delivery of service or product, or the customer just literally has no capacity to buy what you're selling at the price you have to sell it at. But it's a long way. You get there much faster in the discretionaries. And so when you're seeing a marketplace kind of come unhinged, you're going to look at the discretionaries and say, when are people choosing to not buy something because the relative value of it has just gotten crazy? Now, just keep this in mind. Many people listening to this regularly pay $25 for a really bad piece of food or collection of food from a fast food restaurant to be delivered by Uber Eats. And so understanding that what was being delivered, you used to hop in your car, go through a drive-through and get for under $5. So it tells you how far certain things can go depending on what your perception of convenience, usability, functionality, all those kind of things. So just understand there's a lot of flexibility. And by the fact, keep in mind that as inflation, guess what the big thing in inflation is what we pay in wages. People have more money to pay for the things that cost more. So don't lose sight of that. Now, it's not even in that some of the nice employees may not have pushed for the wage that they probably deserve. They're probably behind a little bit versus those that are willing to go into the free agent market and go to the highest bidder. They're doing okay. So just keep that in mind. But we're seeing still massive increases in wages, and especially when you take the bottom end of the wage market. And I'll give you a good data point. So we've got a South Georgia manufacturer that does plastic extrusion, and he was paying $13 an hour for line workers pre-COVID in 2019. He's paying 18 to 20 today, and he's probably about to move it to 20 to 22. That's over 20% a year increase in wages, and he still can't fill up the second shift. So that's real. So let's talk about real. Well, where are you getting your data from? Well, here's the data that the U.S. government puts out in GDP since 2014 and through 21. Now, when I started, one of the things I get to do in EO is I get to chair the EO at Wharton Executive Ed program. And in the first year of the program, Professor David Wessels, who I really hold in high esteem, probably one of the best practical college professors I've talked to. I like to give grief to college professors who've never had a real job. David's had some really good life experiences, and he gets it. He understands it. And he was the one that really turned me on to this idea of return on invested capital. that I use throughout the second book. But I had to go do research because that data point wasn't commonly available. Well, the good news is I got access to hundreds and hundreds of businesses' data that, fortunately, because of our simple numbers technique, we organize that data in exactly the same way for every business in every industry. And so therefore it makes aggregation of that data quite easy. I mean, still takes some effort, and we have to allocate, somebody to do it that's not billing anybody for that. But that's where we decided to be a little different in our thinking. And so as we keep updating that model, I decided to keep going with the model that I used for the book research and say, okay, well, this is useful information, for our clients to see. Well, here's what happened. So the Fed, I was in the Atlanta chapter of EO when I first started, and we had a Fed economist come over to our forum meeting and talk to us about, things at the Fed. And I just asked her the question, and I said, hey, just out of curiosity, how does the Fed get private company information? It says, well, every Fed governor has about 10 companies that they'll call and talk to once a quarter to see how things are going. Really? That's it. A feeling. I got news for you. I talk to CEOs all the time, and their feeling is never spot on as to what is. It's either lagging or forecasting, but it's never in the moment. I guarantee you. And it's like, I couldn't believe it. But there again, I looked at the practicality of it and I go, well, it makes sense. They're taking public company data and doing mathematical extrapolations from wild ass guesses, and notice how smooth this line is. I guarantee you this line in reality was not this smooth, because this is what my data shows. Same group of 100 companies, they were at 20% growth in 2014, 14% in 15, 15% in 16, 23% in 17, 23% in 18. And oh, wait a minute, this is pre-COVID. It was at 8% in 19. Dipped to, wasn't below zero in 20, contrary to what we did not go backwards in 20. It stayed at about 6%, and now it's shot up to about 30%, as you can see, for 21. Now, the thing is, I didn't have to worry too much about inflation adjustment back here. This number from here to here, yeah, there's a lot of inflation in that, and it's just hard to measure. My sense is real inflation is probably close to 15%, maybe 20. Because if I have anything to do with it, I mean, every call, my team and I are just pounding our clients. Have you pushed hard enough? Have you pushed hard enough? Have you raised your prices? Have you found different ways to recoup unexpected cost increases, that weren't in the contract, and all of those things? And so, people keep pushing. Now, here's the thing that I want people to understand. There was a Democrat in the White House here. There was a Republican in the White House here. There's a Democrat in the White House here. They get way too much blame and way too much credit. It is kind of what now they can influence some things, but the marketplace is by and large going to do what the marketplace does. Now, granted, monetary policy and energy policy, those are significant things that are affecting us at the moment. But I will contend this is the most critical data point right here that you got to pay attention to. My contention is we ran out of labor in October of 2019. Right before COVID, we were at the lowest unemployment level that the U.S. economy, had been in since its history. And at that moment, we didn't see it because COVID came the next quarter and really distracted everybody, from that. So this is the part that everybody's missing. I would contend that we would be in the exact same place we're in today, irregardless of COVID. We would be in rampant inflation. We would have supply chain issues that might not be as bad, but they'd still be bad because supply chain is really impacted by many other things other than COVID. And we'd be right in the same morass, because the one thing that my simple numbers philosophy on business has always been built around is the productivity of labor. I think the number one thing that differentiates one business versus the next is, for every dollar of labor spent, how much productivity did I get out of it? I don't care how many bodies you have. It's not about a head count. It is about, for a dollar delivered in labor, what is my margin that gets produced from that? And can I do it consistently, reliably? And how much do I have to invest to get that labor productive? And that model has proven to be, very critical in understanding that when you run out of fuel called labor, you will not raise the top. It doesn't mean that demand isn't there. Matter of fact, the presence of increasing prices is demand exceeds supply. Well, it's mainly a demand exceeds supply in the arena of services or things. Even though we do sell widgets, we do sell things. Embedded in everything is the cost of labor. And as much as shipping is definitely an impact of that, and energy costs are an impact of that, I would contend that the bigger impact of that is the access and availability of labor, and that's going to continue. And AI can't get here fast enough. Um, you know, it'd be nice if we could get both parties to come sit together and sing Kumbaya and come up with a cohesive immigration strategy that we could attract the best and the brightest from around the world and actually, lower, this lack of accessibility of labor needs, in the marketplace. And the one thing to watch there is when you look at the difference between open job positions, and people on unemployment. I mean, that number is at a historical high by a massive number. So here's the data. Let's look at it and just convert all this to numbers. So let me give you some perspective. So our model is built on 100 companies that we have access to. And so we occasionally will, if we lose access to a company's data through, most of the time they end up selling, because these can be successful companies, we have to replace them, much like a stock exchange, but we still go back in time. So this represents companies that we've had access to that data across this time frame. And what you can see is there was an 8% increase in this data set, of companies. So it's about $1 billion, a little over $1 billion, 1.2 billion of revenue through the end of December of 21. And so 8% increase in 20 over 2019 in the COVID year. And this does not include PPP. So we've taken government spending and those stuff out of it. This is just pure business productivity. You can see that revenue in 21 increased 30%. Notice what direct labor did. Direct labor went up 26%. Now, we can't really measure head count, that effectively across this, but I can tell you that almost all of that increase, there was very little head count increase in this increase in direct labor. It's almost all, I'd say 20% of it's probably just wage increases. And I know from the raises I've had to give out in our practice, I mean, it's probably about that number. 19% increase in management labor. So the management labor didn't go up quite as much as direct. And I think typically we see a little bit of a lag in the management labor piece. And I think people are starting to really look at the management labor and say, do I really need that position? If I have to give somebody a raise, can I, change it over? Some people are letting really expensive people go and restarting, from the bottom and just say, hey, we just can't afford that. I'm going to let them go. But those are tough strategies. For the most part, you can see pretty consistent operation. We start to see a little bit of decline in gross margin percentage from 46 to 47. So we're about 2% off here. This is your warning sign out here. 45% gross margin for the year had dropped to 43. So we were off of a high of a 47% gross margin for this group. And we're already 4% down in gross margin. Well, what does that mean? What that means is of the cost of goods that are impacting, either those costs are rising and the costs are rising way more than 4%. It's just more so that even though I've tried to increase pricing, I still haven't increased it enough. And we can tell you, Rob has the same experience, call after call after call. People keep getting hit with cost increases that they couldn't pass through. Sometimes they can pass through at the cost with no markup. Well, I got news for you guys. That's bad math. When you can only pass through the cost increase and not mark it up for margin that you need, you're going backwards. It's so just understand, good sixth grade level, simple math equations, that's not a sustainable thing. Here's the other bigger thing. So we go from pretty much a very consistent labor efficiency ratio. So even though I was giving out these raises here in 21, most people were faster to recover pricing on labor increases that they could see. They're missing more of it on the things that they get hit behind the timeline, in the cost of goods sold. But both of them hit them in this last quarter. You can see the real erosion. We're down to 246 labor efficiency instead of 266, and so this is two things. I'm not recovering this gross margin, and I'm not still behind on catching up for the latest wage increases. And this is the thing you've got to get out of your head. I can't afford to just raise prices once a year. I probably can't afford to just raise prices once every 6 months. I need to adopt the Amazon strategy of dynamic pricing. I need to be always open to changing my pricing. And we've run into this with a few clients that really struggle, that they've got systems that are not easily updated for pricing. And one of the things that I would say that you would want to work with your coach on is really work on, how do I make pricing go faster? There's a great story that Brandon Gray, one of my partners and consultants for our team, he tells about Joe Gibbs Racing. And he said, Joe Gibbs Racing, says, their philosophy is, for decision making is, does it make us go faster? And they built a new building a few years back, and they still don't have a sign on the building. And every time somebody brings it up in a management meeting, somebody asks the question, well, if we put a sign on the building, does that make us go faster? And the answer is always no. It says, well, then we're not putting a sign on the building. All right, what's the next thing on the list? And I think that's a great philosophy. And it's really what you've got to have right now, is what makes my pricing go faster to the operational norm. And, Rob's heard me say this 1,000 times. My mantra in a disruptive time like this is, you must get profitable with what you got. And if you end up losing some of that business that you can't reprice, well, okay, well, let's just keep tweaking our business model and optimize to be profitable with what the customers who will give us a sustainable profit margin, to work through it, and maybe let somebody else be the losing customer for somebody else. I will tell you though, I mean, pretty much across the board, we just have not heard of people losing customers due to pushing prices up. Most of them will tell you, for the most part, crickets. I mean, they haven't heard any. I mean, a few will make a comment or two, and it's not that they like it. I mean, nobody does, but they get it. There's a few that will stomp away and come back because they find that nobody else can do it. And so it's become a marketplace that is really built around this idea of, can you do what I need? When can you do what I need? Oh, and how much is that going to be? I mean, price is that third discussion down the list. And so you really, I mean, you've got to change the sequencing, of things. And we'll talk about some of those pricing strategies here in a few slides. But this is really stark. And if you look at the total labor efficiency ratio, it's the blend of both direct and management together. And I've used it quite a bit more. I did the audio book for both books last summer, and it was the first time I'd read the first book in 10 years. And so I was kind of reminded that when I wrote the first book, I just had the one overall labor efficiency ratio of gross margin divided by all labor, regardless of type. And, it's still an incredibly powerful tool. And I can tell you, for 90% of the businesses, you're an okay business at 1.8, you're a good business at 1.9, and you're a really good business at a 2. And I wish it was more complex than that, or else I could charge more for it, but I like simple numbers. What can I say? Notice what it's gotten to here in this last quarter, $1.68. So just keep that in mind. Here's the bigger picture, and you can see this. So this is a 2-axis graph. The blue line is revenue. That's to the right axis. The orange line is labor. And this is the point that I just keep making to people. It says, listen, all labor and revenue are perfectly correlated. They will chase each other. back here in an expanding economy, labor was chasing revenue because we'd sell stuff and then backfill. We hit end of 2019, and guess what? Labor shot up and revenues having to chase it. This is this inflationary cycle. Look at this. I mean, it starts back here. Like I told you, we ran out of labor. Here it is, October 2019. This is a crossover point. And the economists just drive me crazy, because there's a chart we were looking at the other day, and they were looking at labor participation, and they had just drawn this continuing into infinity line of increasing labor participation, and they can't seem to get it through their thick skull as to why people didn't come back. Everybody's come back that's going to come back, people. I mean, the Economist magazine did a population study 5 years ago, that a publication that's just incredible. Go back and look at it. I mean, they were so spot on in their predictions, and it's like, listen, when you have these mega trends, and I'll show you the data points here in a second. This is it. Everybody's fully. We got to crash the economy, which the Federal Reserve is doing a really good job of by increasing interest rates. But they're going to crash the economy, and it's pretty much guaranteed. We're going to have a second quarter of negative GDP, and so we're in a technical recession, as it is. But it may continue, because if you don't have more people, you cannot create more output. We're at the end of people's productivity for the most part. There was actually an announcement, and I agree with the sentiment. I don't know. I think the number could be worse, but there was an article a couple of weeks ago that said that labor productivity was down 7.5%. I'd probably say it's closer to 15 to 20. People are not hitting it like they were previously, because they don't have to. If you push them, if you press them for more productivity, somebody else will pay them more money and work them less. And guess what, employers? Your employees now have leverage over you. Surprise, you don't have leverage over them. There's nobody in fear of losing their job. That is a different labor market than we've ever had in the US in our history. And you just got to learn to adapt and deal with it. But this is the data that's telling you that. Now you can see revenue's kind of catching up a little bit with labor, but there's other costs that were still messing with us out here. Here's the line I want to point to that I've never seen this steep of an increase. These are non-labor operating expenses, kind of the noise of business. This is the purest sign of raw inflation that I've ever seen. It's just the general cost of stuff going up. And it's not volume related. It is. I mean, this line was going up back here, and you can see the smoothness of this line. This line's going up here, and this line's taking off like a rocket as well. This is the more important one right here. Since May of 21, we've hit the wall in profit. So everybody's playing I'm raising prices just to not lose dollars game since May of 21. This is not good when that line flattens out, and this line is going up. That's just undeniable information in that. So what are we seeing more recently? So we got the model updated through April of 22. So gross margin continues to be in a state of decline, 48%, rolling 12 to 44%. Revenue, it increased 29%, but cost of goods sold, it increased 36%. It's not good. Operating expenses, revenue fell from 20% to 19%. So that's really where everybody, and as a percentage to revenue, that sounds good, but I'm still losing ground because I didn't maintain this gross margin. I gave up 4% here, and I only regained 1%. The fallacy of counting rolls of toilet paper, you can't cut kitchen supplies enough to get profitable. And so, yeah, you can trim a little here, a little there. That there's just not enough stuff in there that's movable that you can make a difference. Notice this: net operating income fell from 9.75 to 806. That's that flattening of that line. Direct labor spend increased 24%. Probably all pay increases. That's not headcount. I mean, I've gone backwards in my office in headcount in the last 12 months. And if you know anybody that prepares tax returns, let me know. I'll slide you a gift card of a reasonable sum. But I mean, it is just difficult. You can see non-labor operating expenses increased 26%. Marketing spend. Now, this is kind of where this is. So we always used to say our marketing clients are what we call our canaries in the coal mine. So marketing spend is the first to be turned up in an upturn, first turned down in a true downturn. We're in a downturn, but yet people are increasing their marketing spend because they're having to change their mix of customers to find the ones that will do work with them the way that they want to work and pay the price that they've got to adjust it to. And so I'm looking for a point that, we've got some clients who were heavy marketing spenders, like in the real estate industry. I mean, right now with the rise of interest rates, most of my real estate agency clients are turning off their marketing spend because they're getting everything that is available in the market. They can't generate demand because as existing homes, really kind of stall because of interest rate rises, they're kind of in a hunker down, waited out mode. And so they got to turn off those costs. But the vast majority of the market is probably still trying to find their way and find their customers. But I would probably say in the next 3 to 6 months, we may see this marketing spend start to stall and start to decline as people have to really make up this net operating income, and they'll start to make value decisions of their marketing spend and say, well, let's keep the stuff that we know that works, and they'll spend less on the more nebulous, hard to connect, type marketing spend. I know you guys don't like to read the balance sheet, but it's kind of important. So asset growth of 32%, liability growth of 40. This is the more important number, return on invested capital, because profitability is declining, is for the model dropped from 65% to 49%. Now, guys, just please humor me. This is the reason why, though, still running a successful, profitable business is still the greatest wealth builder known to mankind, because even in a concerned, challenged environment, we're getting 49% per year of our invested capital. Tell me where you can go get that legally anyplace else. And it generally is going to be 65 to 75% for the model. And so, yeah, real estate, great investment, but you're looking at 8 to 12, maybe 15, maybe a pop to 20 if you get some appreciation and you flip the property in 5 to 7 years. This is business year in, year out, folks. This is still the place to be if you know how to do it. This is concerning. So line of credit balances. So we've seen people have to tap temporary funds, which is a big warning sign to us. And we've seen a 12% cash decline. Core capital, the 2-month core capital target, that number fell 63%. So you're seeing people have to get hit with either they're carrying more in receivables, they're carrying, and more of it's carrying more in inventory. So you can see value of our clients who do carry inventory, that value has increased 91%. So they're having to overcome supply chain issues by increase in trade capital. So trade capital as a percentage of rolling 12 revenues increased from 8% to 13%. So what that means is I've got to be 5% more profitable than I used to be to overcome the growth and having growth pay for itself as I produce it. And so, when I look at trade capital, so AR plus inventory minus AP and deferred revenue, the net of those numbers, those active turnover assets and liabilities, that's the true measure that's telling me that what is my ability, my profit number has to be higher than that number if I want to self-fund out of cash flows. If it's below that number, I either better have cash or I'd better, have access to debt, or I've got to kind of base camp it where I grow in spurts and pause and grow and pause. And that's a difficult, expansion plan, from that. But deferred revenue growth of 59% says some of you or who can get paid in advance are hearing the message. Now, we probably significantly influence that number just because we preach it. We get companies who previously didn't get money up front to get more money up front. And so if your business model can do that, that's your one counterbalance to all those other things going up, in that process. So keep in mind a couple of things here. So don't forget the laws of supply and demand. Unless we get, and there's been some discussion of price controls, if we get either more lockdowns or price controls, demand continues to exceed supply. So inflation is going to exist, whether it's goods or labor. And really, when it comes to consumption, as I mentioned, you guys are paying $25 for that, Chick-fil-A sandwich with some waffle fries and a drink to be delivered, and it used to be $5. I remember when you could get a Whopper for $2, and so I am a little bit older than most of you, but hey, but there's no cap on consumptions of goods. It's just really, can you afford it? What is your wallet share? And so what we're seeing in all of our clients who have discretionary, type activities, either they're on the premium end of things, we're seeing some jumpy demand. And if you're in a premium category, you may have a week where sales are really awful, and then the next week they just clean out the store, and it's like your consumers are adjusting to the fact that they should be getting wage increases. So they really can't afford it, but they're not good with the math. They haven't figured out that they can afford it yet until they see it in their checking account or they see it in their credit availability on their credit card, one of the two, but they'll make those decisions. And oh, by the way, there's things that those customers are spending money on right now during the summer this year that they haven't been able to spend on in the last 2 years. And so you're competing with some of that as well. And so I would just be really careful not to overly freak out for the next couple of months until you see, people understand what their pay scale is. But when you take the bottom 20% of the labor market, these people many of them are making twice as much in wages than what they were making. Now, what they were making was bad, but they're making more money now that many of them, what we're finding in our clients who kind of employ the below $20 an hour class, that people are working for 5-6 months and then taking a month off and just quit, and they'll go find another job. It's like they don't care. They're either living with friends or living at home, and they value the free time and they build up some extra cash to be able to hang around, and that kind of non-technical, unskilled marketplace. It's hand-to-hand combat for that labor, from that. But keep in mind, this is an important point for everybody to remember. This is the first time in U.S. history that there's no excess labor in any category or any geography in the U.S. That is never, even during World War II, there were available people. You had a lot of the women who worked in the factories, and they had labor that they could go get. It wasn't what the labor was used to, but they adapted. You can go look all you want. You ain't finding them. So let's talk about why. This is an older posting. It's actually, I think we're about 11.7 or something like that is the most recent number. Still about 6.3 million. I think we may even be down to 5 point something million in unemployment. But in 2001, we had a 2.4 replacement birth rate. In 2021, it was 1.8. Most people think it's probably about 1.7 right now, and it ain't coming back. It will probably fall even a little further, but it's probably going to stabilize probably somewhere in the 1.6 range. Workforce participation, there's a chart that looks at just total bodies in the workforce. And if you look back over the last 50-year graph, it is amazing to see this hump. It's a camel hump of down, and we're now back to 1960s level total quantity of people in the workforce. Now, if we had not had process innovation, technology, AI, all of those things, we'd be in much world of hurt, and we're hopefully going to see some of those things increase, but it's not going to increase fast enough. Most of the baby boomers, my generation, I'm at the tail end of the baby boomers, and they've already retired and left the job market. I'm still an idiot keeping working, but I kind of like what I do, and like to get a few more rounds of golf in. But my generation ain't coming back to work. And you probably don't want them to come back to work. They're not very technology savvy for the most part. But they will be consumers and not producers for the next 15 to 20 years, and then they die. And so if you really want a picture of what that economy looks like, I challenge you to go to the Wall Street Journal's website and do a search on Latvia. And Wall Street Journal a couple of months ago did an expose on the Latvian economy. And that's exactly this, where the people have left and you've got retirees, but you don't have enough people to serve them and do what they need. That's where we're headed in the next 5 years. And and you end up with some denials of service because it doesn't matter what the price you pay, there's just nobody to do it. And then you've got other things where the price is too high. And really there's then this gravitation. In their case, they actually even have people, what young people they do have are leaving the country for better opportunities elsewhere. So we have to be really careful to make sure that we manage that situation, in a better way. If you're going to be one of the labor winners, you've got to find a way to take talent that's a tick or two below where you need them to be, and find a way to rapidly train, rapidly deploy them for task-specific duties that gets them to at least break even to slightly profitable as fast as possible. And you're not going to send them to schools. You're not going to, they're not going to come out of college with that skill set. You've got to invest in rapid development training that's specific to your job. And guess what? I mean, every time that you onboard somebody, you open up a Zoom session like this and you do a screen share and you hit record. And that's the greatest way to create training content. You still got to organize it, you got to plan it, but it's not just the creation of the content. You have to also create tests for validations, and you got to continue to build that library of content where I've got to put people through reps before I put them in the live fire, on the front line with a customer. And this idea of having time to have a 1-year apprentice or longer of somebody learning through osmosis, you're not going to win that way. You can't afford it. And your customers will gravitate to somebody else who can bring those people up to speed faster. I will say that we've always kind of had this idea of strong culture and fair pay policies have been important, but they're more important than ever now, because used to you felt like you could probably get a little bit of a discount for good culture and fair pay, but now you're going to have to pay the market now and have a good culture if you're going to keep them. But I will tell you, unfortunately, any job that is hard, stressful, smelly, dirty, sweaty, any of those, good luck. Because there may not be a price you can actually get it done. I was talking to a plumber in one of my presentations the other day, and we were having a good laugh at, he said it's tough to train up, those people, but in their case, I mean, he's got the problem of a state regulated licensing program that, takes a couple of years before he can actually, put somebody out there, without them being under a formal apprentice program. And some of those will probably have to start changing, because it's a restraint of getting good enough people out into the workforce. But this is going to be where government policy and the private sector are going to have a conflict. But when, hopefully once that policy person's sewer backs up and they can't get somebody out there because they've restricted, training, for new plumbers and technicians, they'll understand it. So we'll see. But also you've got to have the ability, as you have to dynamically keep your pay policies current with the changing marketplace. You've got to dynamically change your pricing structure, to be able to do it. I mean, and that's just the key. You're going to lose at labor if you can't wait to train lower cost labor and you just have to go for the person who can do it. You're going to just be caught in a pricing quandary that you just can't bill enough for what you have to pay that person. If you have long-term pricing agreements that are tied to consumer price index, yeah, the CPI is going to increase a bit, but there's a bigger gap than ever between real inflation and CPI. Even though CPI is higher now than what it has been, it's still not getting you there. So I think pretty much for the foreseeable future, you're going to see the end to long-term pricing agreements, or you're going to see very creative kick-out clauses, to get out of them. We've got clients who use the H-2B visa program. It's been a great program for people who get allocations of labor. The problem is it's a government toy that sometimes is there and sometimes isn't. And so be wary of accessing through programs that aren't stable in the long run and aren't committed. But if you rely on that $15 or less or even $20 or less labor category, if you cannot pass through those price increases, your business model will be unsustainable. So my restaurant clients, they were paying $13 an hour for kitchen labor in 2019. They're paying $20 to $25 for kitchen labor now. But they've adjusted their menu prices. And you know what? People keep buying the food. They keep showing up. So they're good. It's just simple math. But if you do pass through the price increases, just understand you'll have some customers who will choose to not, that they just can't, it's a bridge too far for the value of that service. Okay. I mean, I get it, but you cannot survive running an unsustainable model. This is the part that may scare you on the supply chain. So in 2020 or 2000, the orange countries represent the dominant trade partners with China. In the year 2000, here's the dominant trade partners with China. So that's not good. We're seeing, my South Georgia manufacturer, he was doing 4.5 million before COVID. He's going to do 14 million this year. So we're seeing manufacturing move back on shore, but they're still struggling and they can't build the new plants fast enough. I did a presentation up in Grand Rapids, and I mean, there is just new manufacturing facility one after another being built, up there. But, still, we got a long ways to go to really, limit, our exposure. And really, I think if you can't, it's the chip manufacturing that is probably our greatest Achilles heel from my assessment. And if we got to get I think there's some in Arizona, some in Texas, some in Michigan that are being built, and we can't get those chip factories built fast enough. So those need to be a priority. If you want to follow somebody, this guy, the Huntsman at man_integrated, this guy has been an invaluable follow for the last couple of years on supply chain information. So I'd recommend you kind of add him to your list. Very entertaining. So we'll run through this and then wrap up. So here's the common pricing errors, and I'll just kind of run through these. Number one is pricing bias. Now, what I mean by pricing bias is this: if you methodically do your pricing, you're leaving money on the table. I did a analysis for a client in South Carolina that was a concrete construction company, and they had exactly the same contribution margin percentage for 3 consecutive years for $17 million a year of revenue. And I said, well, I'll give you an A+ for consistency. I'll give you an F for pricing. And they looked at me and I said, there's no way you can do $17 million a year and get the price that you should have gotten and have exactly the same contribution margin. And they hung their head and they said, yeah, we just found out we were $1 million short of the nearest bidder on our most recent contract. And it's because they method priced. And the thing is, I get it. I'm not saying don't method price eventually, but you've got to start the pricing process and say, what will the customer pay? What is the market value of this product or service that we're delivering? And then I go do my cost analysis. If I start with cost analysis, I'm dead. I can never get my mental viewpoint up out of the gutter of method pricing to get to market pricing if I start with the analysis side. But definitely do it. And 2 outcomes. If the price I think the market will pay is better than my method price, I'm going to charge the price the market will pay. If my market price is lower than my method price, I've got my tools to go back to the customer and explain why. It's the reason why I have a $150,000 pool in my backyard instead of an $80,000 pool. Because when I went to the guy who's going to build it, I told him that was my budget, was 80,000. And he explained to me what $80,000 would get me in a pool. And then as he designed the CAD picture of what the $150,000 pool looked like, I go, well, that's definitely what I want. That's not what I want to pay. Is there some place in between? So then he designed the in between that was about 120. And I go, no, I'll pay the 100. I'll find a way to pay the 150 because it's from my 4 granddaughters and that's what they deserve. And so that's why I ended up with 150,000. But that's exactly the whole point of psychology around pricing. Cost plus mindset, same kind of thing. Understand there's a reason why Jack Welch got GE out of the cost plus contract business back in the late 90s. He said, why would I want to limit myself to 6% profit? And that's what cost plus pricing does. It's the lowest form of profitability. And oh, by the way, cost plus doesn't mean cost plus because there's generally a cap, a spending cap. And when you have a cost overrun, you'll find out pretty quickly it ain't cost plus anymore. It's called costing you, not cost plus. One price for everyone, bad idea. Every customer is different. We all mean well. We all have this philosophy. Oh, I want to treat everybody the same. Really? I, no. I mean, there's some people you should treat differently, good or bad. So understand. I mean, every customer has a different level of need, and you are either overcharging or undercharging depending on trying to have this one price for everyone. There should be, there's certain things that'll be common, but realistically, you've got to put that dynamic in there of saying, why it should be different. And I learned this. And a lot of times speed is the greatest determinant. So client that got me into EO, Ron Hollis, the CEO of QuickParts.com, they had a rapid prototyping business to where you would upload your file to their website and they give you an instant binding quote for a custom manufactured prototype to be delivered tomorrow. Now, the thing is there's a price if you want it delivered tomorrow. There's a different price if you want it delivered in 2 days, a different price if you want it delivered in 5 days, and a different price if you want it delivered in 2 weeks. And it was all really built around the idea of platform utilization of a stereolithography machine. And so if I have to build it, regardless of any other orders that I have, I may have inefficiency of the platform. If you give me 2 days to fill it up, I can get a little better efficiency. You give me 5 to 14 days to fill it up, I can maximize that sucker and really knock it out of the park. And so it's a win-win for both parties. Is it urgent? Is it necessary? We also look at, kind of this opportunistic thing. There's a reason why dentists are generally one of the highest, producing medical professions is because of their scheduling methodology of holding high value appointments open within 24 to 48 hours before they fill them. Because when you have a routine cleaning and you have a filling, it's going to be 3 months before you're back in because it's a low value thing and it's not urgent. Nothing bad's going to happen. But if you have a crown, a root canal, or cosmetic dentistry, hey, we got an opening this afternoon at 2. Can you just hang around and we'll knock that out for you? Guess what? I mean, they're treating you differently than they had other people that wanted that slot, but it wasn't as valuable of a customer. And you got to understand, I guarantee you, everybody listening to this call today, the vast majority of you, your capacity schedule is booked out for weeks, maybe even months. Why? You need to have some high value slots in there, regardless of demand, that says, who is it that is willing to pay a premium price for it to get there sooner? You gotta move up the line. I mean, this is Disney 101. Do you want to be in the fast lane or you want to be in the common lane? That may be an untasteful way to think about it, but you're leaving profitability on the table that, listen, you need that profitability because this marketplace is going to give you a lot of other bruises and broken bones that you're going to need that profitability to make up for the stuff you can't control. So I'm just throwing it out there. We talked about pass-through cost increases. You got to pass it through with margin. Long-term contracts without kick-out clauses, you got to avoid those things. Please do not bill by the hour. If you bill by the hour, there's only 2 possible outcomes. You're either giving away your expertise or you're charging for your ignorance. You got to productize what you do. There's only, there's 2 reasons why people do not do a fixed price and they billing by the hour is lazy. because you're unwilling to spend the time and effort in scoping, and you're unable to manage to the scope. That's why you don't bill on a fixed price basis, and you should. And the data is undeniable. The people who bill on a fixed price basis are significantly more profitable, but they're well managed, and so that's a challenge. This is an unusual one. So I was talking to my manufacturing client up in Minneapolis last summer, and they were struggling profitability wise. And I said, okay, well, what's why? And they go, well, we got some contract guys that they're a little slow on the uptake, and we got a bunch of them, and they're kind of all falling all over each other. And I said, well, have you increased your prices? And it says, wow, they're inefficient. It says, listen, everybody's inefficient right now. You have to price in the inefficiency of the people, because I guarantee you, your competitors are inefficient too. And it's like, don't think that you can price based on the best possible outcome and efforts, to everything, when the market is this fractured. Now, when there's plenty of excess labor, I get it. But right now, you need to price in the conditions of what is there. And it's just get over it. Obviously, getting more volume it can cause you to lose money faster. So just be careful. If you go for volume, you're going for volume with the value that it needs to have. And then this is the last one I'll throw out there, and then we'll open up maybe a few questions here before we wrap up. But in the past, we've generally, if you've had a product and a service that's bundled together, you've tried to do bundled pricing. We're in a mode now to where labor is moving potentially at a different cost rate than the goods. And you may actually be in a period of time where I need to unbundle the product and the service to be more effective in my pricing. Because at least and we've got several situations where people are having to give quotes right now, and I can probably better guess my labor rate 9 months from now than I can guess the cost of an HVAC system that I don't even have pricing on, and I don't know what it's going to cost. And so therefore, my HVAC companies that we do a lot of, it's like, okay, well, quote them a price for service and installation. Here's the base price that we think that unit's going to be. And when it comes in at a different price, we're going to adjust what we bill you, because I cannot, my supplier will not even give me a price or a delivery date, that item. And so you're in a situation where you're playing a really big gamble if you continue with bundled pricing in those type of situations. So in this deck, and I'll send it out to Rob, we've got some service business pricing strategy bullet points, some product pricing strategy bullet points, and then some manufacturer pricing strategy bullet points. So those will be in the deck, then when he sends it out. But we'll kind of pause there, and Rob, if you got any questions or things we need to discuss.
Yeah, so I want to talk about one of the most common things that I've heard from my clients, and I'm curious if you've how you respond to your clients. And I want to go, and this is about the labor shortages and the
Mhm.
fact that we're still seeing a lot of people that are having key employees poached for ridiculous rates, right?
Right, right.
They're a $60,000 to $80,000 employee, and now they're getting offers for 120,
Mhm.
130. What are you advising your clients? How do you handle that? And more importantly, how do you get proactive to make sure that you have a strategy for retaining your clients when you have these labor increases happening?
Yeah, so there's typically three approaches that you're having to do with those. So one is you've got to define, when does a price just is a bridge too far. I mean, that person has just priced them out, and the no matter how much I wish I could raise my price, I cannot raise it enough with my existing customers to where they'll pay that. And we've seen that in our professional services clients, our IT management clients, and so they've said see ya, to some of those folks that just got outside of that. Secondly, you got to know of the woes. I better be proactively adjusting people's pay to what market is, and then I've got to adjust my billing rate, and nobody's going to be happy about it. And it's like, fine. I mean, but this is, everybody knows this. I mean, if anybody is caught by surprise by this, they've been living in a hole somewhere. So and that's just kind of the way it is. The third piece is I've got to find international labor that I can tap. And so in our CRI's partner meeting back in January, we had a futurist come in, and he was really this guy named Jack Oldrich, which is a good follow on his weekly newsletter as well about, future things. But he was telling us, he said, if you picture a flat map of the world, what is at the center and at the top of every flat map of the world? Well, it's England, because they were the center of the world when the flat map was first produced. And we just kind of kept that perspective. Well, unless there's some flat earthers on the call, last time I checked, the earth is round, and the North Pole could have just as easily been called the South Pole, in terms of which somebody picked an orientation of which is which. And he said, just humor me, take a flat map picture of the current world and turn it upside down. And now draw a line through the middle and look at the northern hemisphere then of that new version of the world. That's where the excess labor is. So there's about, so right now there's reliably about 8 billion working people in the world, working age people, and 4 billion of those have reliable high-speed internet. The other 4 billion do not. As soon as Elon Musk completes his Starlink strategy, all of a sudden 4 billion people who previously didn't have access to reliable high-speed internet will now have access. And it's opening up labor categories. Now, some of those are more developed and more long, got better English language skills, what you need. Some, and so, I mean, our clients who can access international labor are doing it with unprecedented speed, at the moment. And so that's the third strategy of what you got to deploy.
And the other one that's kind of interesting, and again, I'm being a little selfish here because I have a lot of clients that are in this.
Mm-hmm.
When you say contract negotiation errors, when people
Mm-hmm.
have long term pricing in their contracts, or even projects. I mean, I have a
Mm-hmm.
construction client,
Yep.
that might be 2 3 years on a single project. So, what are
Right.
some of those strategies there, especially for a small business owner that may not have, the capacity to be able to really sway much? What do you do?
Well, you probably got more capacity than you think, because there's a contracting officer for every one of those long-term contracts. And what that contract person understands is, yeah, I mean, there's typical mitigation of you cancel a contract or get out of it. They don't want to do that. And so we've seen really creative ways of people dealing with things that were under contract. Because here's the thing, if you don't ask, you don't get. So you need to open the discussion and just be honest with them, saying, listen, you know, there's a point that I may not be able to finish this contract. And, I know we had a contract, but this contract was done in a time that we're not like this. And so we've got one contract that does construction equipment for the federal government. And they've actually found a way that they'll actually cancel contracts and redo contracts because the equipment, and they'll do, and the contracting officer understands this, that it's better off for my client to not finish a contract and not deliver that piece of equipment than they'll lose more money by delivering it under the original terms of the contract than what the contract termination costs are. And you got to understand the difference between those two to have some negotiation leverage. And really what the customer wants is things to continue, on path and completion. And so we've seen some things to where people have been able to work that out. And sometimes you just have to get creative in terms of, we've had a few clients that have bid some contracts that kind of ate their lunch, and so you go into really a strategic mode of can I quickly finish this at the least amount of cost and get it off my plate so I can then start creating positive margin with properly priced stuff.
Yeah. And then this is kind of along those same lines, but when you talk about changing your prices rapidly,
Mm-hmm.
and I know it's different for different types of industries, but what does that
Yep.
mean to you? And how are people doing it?
So I'll give you a couple of examples. And so we had this Ace Hardware client that literally I mean, I'd push him to raise his prices, but it's like, I mean, he can change things in the computer, but the problem is you got bins of stuff in the store. And so, yeah, you go into a Lowe's and Home Depot. Lowe's and Home Depot has a team of like every store has a team of 3 to 5 people that constantly every day is taking a section of the store and do two things. They're taking a rolling inventory of that section as well as adjusting prices. And they'll sometimes surge that as well, depending on need. And so, but a guy that's running a single store, I mean, it's a lot of effort to go through and hand reprice stuff. And so this is kind of where I said earlier, you've got to come up with a strategy of how do I make, you know, fast pricing changes more effective, and what are the barriers that are keeping me from doing that. And so whereas you see a lot of restaurants that go to QR codes for menus because they can change prices without reprinting anything. And that's as people start to adapt. I mean, that's really where you're going to. So that's really where you've got to kind of work into those things, and just try to find ways that I can almost be like Amazon and literally change it dynamically.
Yeah, that's a really good point. And the other topic that you and I have touched on quite a bit is,
Mm.
I think any business right now that's not looking for ways to do any sort of automation with their
Mhm.
systems, and you
Yeah.
have to be doing that. You have to
What?
figure out the highest and best use of each of your team members.
Yeah.
And I know that's something that you harp on a lot.
Yeah. So here's the thing that I think. Let me add this because that's a spot on comment that I should have said something earlier about it. Because in the past, you made automation decisions that saved on labor cost. You're going to have to make automation decisions going forward just so you can actually do something. It's not, it really isn't about the cost of the automation. It is the cost of, can I deliver a product or service to the customer because I've augmented with this automation that literally my business would go out of business if I didn't automate it, because there's not a human that's willing to do that.
Yeah, I'm still shocked at how many more places, especially in the airports, where it's all self checkout,
Mm-hmm.
right? You know, they've got it's. I mean, it's just happening everywhere.
And they've trained us to be good little self-check bag checkers.
Yeah, at least they haven't trained you how to make your own latte yet. That would probably be a bridge too far.
No, they have. In the Austin airport, there is a non-attended automated latte station as you head towards the Delta terminal, or the Delta gates.
Very nice.
I
Very.
didn't. I was in a hurry. I didn't get it. I was going to test it out, but I've already gotten a Starbucks latte. But it's coming.
Yeah, yeah. Well, I don't see any questions. And here we go. Lauren says, "What is your view on businesses who normally don't carry inventory that start carrying inventory because of supply chain challenges?"
Yeah, it's happened quite frequently. Yeah. So what you're looking at there are making strategic purchases and inventory of things, common goods that will it always, because you weren't carrying inventory because you were relying on just-in-time inventory delivery of goods because I didn't have to carry it. So if you can specifically identify, an item, it is called selling the customer what exists versus what they want. And we've got an example. We got a client that's a furniture company, and so their previous model was, you come in, you look at the showroom, you select the furniture, in 3 to 4 weeks it'll be shipped to you. Worked reliably until COVID hit. There was a shortage of foam. I mean, we had a shortage of foam that destroyed the furniture industry, for over a year. Ashley, which was one of their lines that they sold a good bit, has just now caught back up to a point. They're still not back to full production. But now what they're doing is, you walk in and they bring up the screen and they're looking at what is available to ship immediately from the warehouse of what they want, and you're less reliant on what the in-room showroom furniture is, and you're selling. People are making buying decisions of what can I get my hands on within my time frame, rather than I think I want this material, and I want this chair and this couch. Hey, is it a table? Is it when can I get it? Because they were getting, first they got 4 week schedules, then oh well, it's stretched out to 8. Well, and now it's 13. Uh, Now they canceled it, and so if you can define the things, and one of the things I would say is if you can actually do kind of like what they were doing, where the manufacturer is still holding it. If they have an inventory, you can still get away with it. But if you literally have to go ahead and pre-buy, one of my clients is actually doing that. He's putting in what he refers to as phantom orders, and he knows his cancellation date. So he's put in the order to get in line to get the thing that he thinks he's going to sell. So he doesn't have a customer yet, and he's marked the due date of when he can cancel it without penalty if he doesn't sell that item by then.
Yeah, that's a good strategy. Just yesterday, I played golf with a couple of people in the paper industry, and I asked them. I said, "How are paper sales going?" And they go, "Oh, it's easy. If we actually have paper to sell, people buy it. He said, it's just a matter of actually getting it."
Yep.
Let's see. Kelly asked, "Are you seeing any pricing trends on businesses that are only service based? For example, advertising agencies, graphic design, and so forth."
Yeah, all my marketing oriented clients, it's called, you take the sum of the labor that you have on hand, multiply it times two, and that's the gross margin that you got to go get somehow, some way. And so until you've raised your productivity and pricing to get to that 2-to-1 overall labor efficiency ratio, you haven't charged enough.
Yeah, and I'm also still seeing. I'm still amazed. I mean, there's also still a big trend. Obviously, the gig economy has
Yeah.
changed the
Yeah.
expectations. I think the pandemic has changed the expectations for a service-based business
Hmm.
of what you can get and where you can work. I was coaching one of my clients the other day, and they were like, "Hey, if I can find somebody that's willing to work 25 hours a week, I'll take them."
Yeah, absolutely. Yeah.
I
If I
mean,
found a tax preparer that wanted to work 20 hours a week, I'd say yes. When
yeah.
can you start?
Um, and I had an Uber driver, and he was telling me the story about how he was a pipe fitter in a construction business, and pipe fitters can make some pretty good money. But he says, "I'd rather work 3 days a week. I drive about 10 to 12 hours, and I make as much money as I did before, and I control my schedule."
Hmm.
And it still just amazes me, but I think as businesses, you have to
Yeah.
look at your labor force and ask yourself, is there anything we can do to be more flexible
Hmm.
with our workforce?
Oh yeah, yeah, you absolutely have to. There's no doubt about it. And and I think we'll see the constriction of office space, really being shrunk as people's leases come up for renewal. Um, I mean, I less than half of our staff is in the office in any given day that they're, you know, and I regularly told them, I said, I don't care where you work, just get your work done. I mean,
Yeah.
yes, you have to manage differently, remotely, but we got Zoom, we got Teams. I don't have any trouble communicating with them.
Yeah, and
Yeah.
just to jump on that, the biggest change I've seen with my clients, especially the ones that are 100% remote, is they're
Hmm.
being more intentional about bringing people together.
Hmm. Yeah.
Whether it's a monthly event, a quarterly
Yeah.
offsite, or something where they actually get people together to maintain that. All right, any
Yeah.
last
Yeah.
questions for Greg? I'll put it out there for the chat. This has been awesome. Just as a reminder, we will send out a copy of the recording. We'll send out a copy of Greg's deck. I know that Greg is always welcome if you want to shoot him emails. And of course, if you're not using the Simple Numbers system, I highly recommend you reach out to Greg, and he'll connect you with Mike Maxon, and they can walk you through their process. Um, Anything else? Anything that's on your horizon, Greg, that you're watching, thinking about for the third book?
No, not so much for the third book. I mean, my horizon right now is I just hope that the Federal Reserve chairman gets some sense. I mean, so if you look at the last 7 times the U.S. was in inflationary spiral, the Fed has a perfect record in that they pushed us into a recession all 7 of those times. I will give you really good money odds that when the June data comes out, April data has already come out and it was down as well. So I mean we're in a recession, as it is, and what the interest rate rise is doing to the real estate market is it's going to hurt. I don't. It's still not probably going to create excess labor anywhere, but it's really going to put a real hurt in an industry that then as they moderate off of it, you're going to see an even a greater inflationary surge. If they bring the rates back down, then all this pent up demand that's set on the sidelines for 3, 6, 12 months, depending on how long they keep pushing rates up. I mean, pretty much if they can maintain more long-term mortgage rates roughly in the 3.5 to 4% range, that's the fair number. That's the number that works. And you know, but when they get out, when they push rates higher than that, it just becomes destructive to people's lives. And pretty much, it's um, you know, I think we're going to have to learn that what people don't understand is with this labor imbalance situation that's not changing anytime soon, and we're going to have to learn to live with 10 to 15% annual inflation for the foreseeable future. And you can that's okay. We got to teach people math again, but at the end of the day, I mean, Argentina has lived with this for years, and guess what? They still function. I mean, I wouldn't want to live there, but last time I checked, the sun still comes up every morning.
All right. Well, on that note, the
Yeah,
sun still comes up every day. That's a
that's right.
positive message for the
There you go.
for the group. Well, listen, Greg, thank you so much for
Okay.
your time as always.
Thank
I
you.
appreciate it. I think I'll owe you another round of golf somewhere.
That is all right. We will. I think we have one planned here
I
coming
think we
soon
have
in
one
in
planned
the
soon.
Emerald Isle. So
There you
uh,
go. Thank
we'll
you,
do that.
everybody, for joining the
Okay.
call. I appreciate it. We will be doing more of these webinars. John and I have a couple of more speakers lined up, so be looking forward to that. Thank you very much and have a great week. Thank you,
Thanks.
everyone.